Guys, it's payrolls tomorrow. Can we make sure we're not taking lunch off the desk, please?
The labor market somehow contrives to give us 8 years of Trump. I don't know what I'll do.
Probably nothing.
I built an indicators monitor. Weekly jobless claims, credit card arrears, Google searches for vacancies are all rolling over.
Good edge.
I'll circulate it. It's a finger in the air, but definitely something.
I like it. Cool.
So here, this is the trading floor, and they're talking about payroll numbers coming up. Now, the non-farm payroll numbers is a number that's published out of the US. And it's one of the most important economic indicators because what it does, it gives you a good sense of the strength of the US economy, which obviously is going to be very, very important for stocks and also potentially interest rates because it will help give an indication whether the Fed will ease, in other words, reduce interest rates, or tighten, in other words, increase interest rates. So it's a very, very watched number, and there'll be predictions about what it's going to be. So that's what they're talking about, payroll numbers. And in the US, it's the key number is non-farm payrolls. So in other words, non-agricultural payrolls. Now, Harper comes in and says, well, she's got a whole load of other data stats on things like jobless claims, credit card arrears, and that kind of information is becoming more and more available as we've got big data. And actually, if you're an algorithmic hedge fund, you often will get data that's much more up to date than things like the non-farm payrolls number. In fact, some of the hedge funds, what they're doing is they're tracking mobile phone usage by buying data from people like Verizon, and they're establishing how many people are in shopping malls. So actually, the world is moving on very, very quickly in terms of the kind of numbers that are changing investment decisions. But nevertheless, the non-farm payrolls number is super important. It will be very clearly watched. And if the number comes out below or above expectations, then the market will move really quickly.
I think it's great.
Harper, it's Duncan Hickson, middle office. Can you call me as soon as you get this in order to discuss something urgent?
The market is backed up.
You coming?
So here, Harper has been called by a guy in middle office. Now, the term middle office is actually a little old-fashioned. Traditionally, there were kind of three offices. You had the front office, which Harper is in, and they would directly interface with clients. The middle office would be a direct support team to the front office. So, for example, they would do the traders' profit and loss statements. They would make sure all the trades were booked, and they may also include compliance. The back office is all the kind of overall infrastructure administration. So that would include human resources, all the finance and accounting of the institution, things like that. So that's broadly how it used to break down between front office, middle office, and back office. Now, the terms middle office and back office, particularly back office, they have pretty much been abandoned in the industry, partly for it's a kind of very snobbish way to talk about the industry. It's still, people do still do that, but actually it's more, for example, at Goldman, they talk about the federation, which is really kind of a blend of the middle office and the back office teams. But how they view that is managing the risk of the business. Actually, it is almost as important as a client interfacing front office or the client facing role. So actually, nowadays, people don't have this kind of sense of back office being a weak part of the chain. It's actually a critical thing to run an effective investment bank, because on the one hand, you've got to manage your revenues and your client relationships, but on the other hand, you need to manage your risk, and that's what all the kind of support roles do in the institution, and they are really important.
Duncan?
Yeah?
Harper.
Ah, the elusive Harper.
Hi, sorry. Crazy morning. How can I help?
Forwarded you a timestamp on a mismatched trade, Allerton Capital.
What's the issue?
There's a discrepancy on the notional. Graduates have done this before, so I just need to check. Did you buy the right currency? You've booked 50 quid. Allerton are confirming $50. Which is it?
Sterling. Quid.
Allerton's confirmation says it's a dollar amount.
So this is where Harper's mistake is coming back to bite her. And if you remember from the last video, when she was booking that trade, it was clear that they were buying sterling rather than buying dollars. So she booked it incorrectly. And what has happened here is that the other side, that the investment manager has booked the trade as a purchase of dollars, whereas Harper or Pierpoint have booked the trade as a purchase of 50 million sterling. And that's what the mismatch is. One side is saying, well, we're buying dollars. The other side is, well, we're selling pounds. And so that's what's happened, is that it's come up, being flagged as a mismatch. And this is why this is the office that really is kind of supporting all the booking of the trades, and they're bringing up, flagging that there's a problem here. And when they talk about notional, now in the case of FX, this is broadly pretty much a cash business. So it's cash changing hands, and the notional represents the 50 million. Now, if it was a derivative trade, and I talked about derivatives in the last video, where you're paying a premium for the right to buy or sell in the future in the case of an option. So if it's a call option, you pay a premium, for example, to buy $100 million in, let's say, a month's time at a fixed price. And in that case, although the premium may be quite small in relation to the 100 million, the 100 million is the notional amount, okay? But the premium is the actual upfront cash payment for the right to do that. And that's what typically, when people are talking about notionals, is an important point in a derivatives trade, because it's kind of the underlying purchase amount, not necessarily the premium up front. So Harper is in trouble, and what will happen is they will pull the tapes and they will figure out that Harper actually did misbook. Well, she actually did the trade wrong. She booked it as a purchase of sterling rather than a purchase of dollars.
It definitely wasn't.
Call the client, I'm sure he'll rectify. It's probably their mistake. If it's yours, I need to know ASAP.
Do I need to tell my manager? Is this a serious issue?
Absolutely, you should. Not telling him is not acceptable.
Okay, I'll fix it.
It's likely at this point that they wouldn't just let it go and let her walk off and talk to the client. This would be a very, very serious issue. For starters, she wouldn't be able to trade those amounts as a new analyst or an intern. It's just, that's very unlikely to happen. And she wouldn't just be left to her own devices on a mismatched trade in her first few weeks. Someone else will be looking at it. So this would be a very, very serious issue. And if she lies, it's pretty much a sackable offense. It's gross misconduct. You can't have somebody lying in a financial institution when such large amounts of money are involved.
Shouldn't have run you over just because you're young. Amend the trade in the system to $50 and see what the loss is.
Flew them in on a helicopter. Isn't that wild? Oh, no, I don't get it.
Okay, I imagine it's quite a hit. But sell now, and at least we've contained
I
him.
think it's very much.
Harper. Is it done? What does it say?
Says it's all squared away.
Good. Well, I was dreading the team meet. You, we were slow on this one.
When is your meet?
1:30, just after non-farm payrolls.
Now, there's a couple of issues here. Firstly, she is unwinding the trade. So what's happened is they have booked the trade as a purchase of sterling, but the client actually wanted to buy dollars. And so what they've had to do is they basically had to unwind the purchase of sterling, and they would have sold dollars at the time to purchase the sterling. So what's happened is the exchange rate between dollars and sterling has moved against them. And so in unwinding that trade, they have had to effectively sell sterling and buy dollars. And because the dollars has strengthened, they're sitting on a loss of £50,000. And so that's a significant loss. Now, traders generally, they're not allowed on the trading floor, they're not allowed to take positions for speculative purposes. Okay, those days are over inside investment banks. And as a consequence, their main job is making a spread between the bid and ask, and therefore get lots of flow, lots of trade through their books. And that means they get lots of the spread between the bid and ask. So it's unlikely that this would ever happen. Loads of red flags here. This would be a major issue, somebody not actually immediately unwinding something. It should have been flagged by compliance to her boss on an immediate basis. So it's really unlikely that this would happen, particularly in this day and age. Now, the second thing that I want to mention is you can see on the screen the US employment numbers released. And you can see here they've got the different payrolls. They've got non-farm payrolls, private payrolls, and government payrolls. And the forecast numbers you can see for non-farm payrolls are 150,000. Now, the consensus is 250,000. So I'm guessing that 150,000 forecast is Pierpoint's number. The consensus is the average of the street. So what the consensus is what Wall Street or the City of London is thinking generally, 250,000. Pierpoint saying it's going to be lower than expected. So these will be increases in employment for non-farm payrolls. They are expecting 150, whereas the consensus is 250. So that means these are weaker, they are predicting weaker numbers than consensus. Now, you can also see the column that says prior. That is just probably where the consensus was maybe a week prior. And you can see in this case, if it's the consensus number rather than the Pierpoint forecast number, the consensus used to be 228,000 and now it's strengthened to 250,000. So it doesn't give much more detail than that, other than they've got the unemployment rate of 3.6%. And I'm assuming this is US because they're talking about non-farm payrolls, and this is yes, it says it's US at the top. The unemployment rate of 3.6% actually is incredibly low. We are in a really low unemployment rates it's certainly at 3.6%. Traditionally, it would have been full employment at unemployment of 5% because you'd have some kind of friction of people changing jobs. So these kind of numbers are super important on the trading floor.
Yeah, Eric will flip, but you risk your job if you don't come clean.
Why did you make me stay up all night?
I didn't make you do anything. Look, you're his project. You're allowed to make one mistake.
No, actually, I'm not. I'm not allowed to make any mistakes. People like you are allowed to make mistakes.
What the fuck does that mean?
Mistakes are a privilege.
Okay, yeah, well, the loss is hypothetical. In the book. It's live, right?
Yeah, so?
Well, then it's not crystallized. So surely it can still swing to the upside or the downside.
If the NFP's under 150K at 1:30 this afternoon...
That's a fucking punt.
No, there's less chance for Fed rate hike, which is bad for the dollar. Sterling surges against dollar, and my loss is totally offset.
So just tell Eric. All right, you're not thinking properly. The street's looking for 250K.
You don't know what the fuck you're talking about. So why don't you just stick to whatever it is that you're good at?
Now, this is quite an interesting conversation that they're having. And I just wanted to explain the kind of economics behind it and why these things are interlinked. So they're talking about the non-farm payrolls number. And in this case, the consensus, the street consensus is 250,000 new non-farm payroll jobs. Pierpoint is estimating that they're going to be 150,000 new non-farm payroll jobs. In other words, Pierpoint's saying that the numbers are going to be much weaker than the street consensus. In other words, the economic activity is going to be weaker. Now, if the economic activity is weaker, it's much less likely that the Federal Reserve will raise interest rates. In fact, they may even lower interest rates. And one of the things that is affected by interest rate predictions are currencies, because if investors think that the Federal Reserve will increase interest rates, and they may do if they're very, very strong employment numbers, in other words, the 250 number, that means investors will want to take advantage of those new higher rates, and they would want to buy dollars and get their deposits in dollars to take advantage of the higher interest rates. And that increased demand for dollars will push up the value of the dollar relative to other currencies. And that means that the dollar would strengthen. So the street consensus is to have very strong employment numbers, which means interest rates potentially will rise, which means the dollar will strengthen, which was the whole kind of trade around that fund manager buying dollars. Now, interestingly, that completely contradicts Pierpoint's view that actually the non-farm payrolls are going to be lower than expected at 150, so therefore rates shouldn't hike. Therefore, we should see the dollar stay the same level or even decline, particularly if the investors have priced in interest rates going up. So actually, although it contradicts where Pierpoint is, in terms of the advice they gave the investor to buy dollars, what Harper's saying is that actually if the numbers come in lower than expected, which is what Pierpoint is actually saying, then the dollar will weaken. But in other words, what she's doing is taking advantage of the fact that to unwind the trade, she has to buy dollars. And if the dollar weakens because the employment numbers are lower and therefore interest rates are less likely to go up, then she potentially will be able to buy those dollars back at a cheaper price. I'm actually just touched that you love it.
Published on the Whispers about a new bubble in tech, interest for Casper. Rishi?
Now here what we're seeing is the equity research analyst hand out a note. And generally in research, they will publish full reports, often when they start covering a particular stock or security. And then on a regular basis, they will publish a much shorter, in this case, you can see it's one-page note, which is either because something has happened or they've got a particular view, usually in relation to some particular event. In this case, there are whispers about tech being overvalued. It's unlikely that they'd hand out paid paper like this individually. This is much more likely to be electronic nowadays than handing out paper. But in this case, because it's a one-page note, it's a short note on some particular event rather than a full report. And they will do on a reasonably regular basis, maybe every quarter, every 6 months, do like a full report on the company in some detail. But in this case, this is just a short form.
I'll have 4 sugars. Bit of a bastard behind the eyes. Hungover. You haven't covered that risk. Your P&L on that trade is minus 50,000. You're not authorised.
To level with you, I'm still working on the client.
So you lied to me?
No, you misunderstood. I'm just softening them up a bit. It's their error. I just need a little more time.
I'm not going to be held responsible for your lack of responsibility. I'm empowered to report this. It's literally my job.
I just need until 1:30 p.m.
That would be gross negligence.
Well, is it illegal?
No,
Is it unethical?
that's muddier.
Well, so we've established that it's not black and white then.
That's not the point.
Look, this is on me. You can be ignorant. Our conversations...
They happened. I don't care about the electronic trail or the audio trail either. It's the principle.
Now, this is just unrealistic. This is somebody whose job it is to make sure that all the trades are booked correctly. He's talking to Harper, who is an analyst or an intern. It's just simply no way that he would let this go. She's lied to him. He would immediately involve compliance. She would immediately get disciplined or put on some kind of suspension. It's just this would never ever happen. Now, don't get me wrong, because it makes great drama, this. And have things happened like this in the past? Yes, but usually from a very experienced trader. And actually in most of the really big scandals in the past have been where a trader has worked in some kind of support role in what they're calling the middle office. They know the kind of systems and they know the kind of workarounds. That's usually where the big scandals have been, like in the collapse of Bearings, for example. So it's just unlikely that this would happen with such a new employee. I just think that's really unrealistic. But, you know, this is TV and it's drama. They need to kind of amp it up a bit. So I totally understand why they've done this.
Sorry, I'm looking at wage growth too. What?
I've just spoken to Aubrey at Allerton. Why did you lie to me?
Your middle office, you shouldn't be calling clients.
You made a mistake. So what the fuck do you think you're doing?
15 seconds to the print. It's gonna be soft, then we're clear.
But, no, Harper, you can't trade your way out of this. That is unacceptable. It's reckless.
This is where we are now.
Harper!
Just wait. The announcement's coming in 5.
Big miss on the number. Plus 120 versus Street at plus 250.
What did I say?
Told you.
Okay, pull up the trade and put loss sheets. I shouldn't be doing this.
Okay.
It's already done.
Execute anywhere within 10 grand and you might get away with this.
This was one-way traffic. Print is soft. I'm running it.
Harper, don't fuck around. Cover that risk now. Harper!
There's a reason I'm sat here. Bear with me.
So this is playing out in Harper's favour initially. And it's, again, very unlikely she would have the guy in the middle office. I mean, he would be calling her boss right away. That simply wouldn't happen. But nevertheless, as I mentioned before, what's happened is that the actual payroll number came in at 120, and that, in fact, it was weaker even than Peerpoint predicted at 150. The street is at 250. So the street was expecting a much stronger employment number. As a consequence, there's a much less likelihood of the Fed raising rates. They may even ease rates. And as a consequence, you're going to get a lower return on your money in the markets in the US. And so therefore, investors will start pulling their money out of dollars into other currencies. And you can see here that the dollar quote, or actually it's a sterling quote, that 132 number is the number of dollars it takes to buy £1. And what's happening, that's rising because the sterling is strengthening in relation to the dollar. So it's costing you more dollars to buy £1, and that's why that's going up. And the reason is that people are basically wanting to buy other currencies rather than dollars, and that's weakening the dollar. So in this case, it's all gone to plan. Harper was right. She correctly thought that the number would be weaker than consensus, actually, as did Peerpoint. That's their house view, and this is running in her favor. The dollar is weakening, which means that she can then sell sterling and buy more dollars than she originally sold when she incorrectly booked the trade. So she comes out clear, but unfortunately she doesn't do it in time because then it reverses.
Ivor's buying dollars. It's fucking Ivor, man. Stored now, too.
First move's always wrong.
Fucking hell, Eric. Ivor's lighting us up, mate.
Of course he is.
Harper, I am going to come over your hood and broadcast this if you do not execute at this level now.
So you can see that things can suddenly move the markets pretty dramatically. And although actually the dollar weakened, suddenly it's strengthening. And actually the supply and demand has really the biggest impact on prices in the financial markets. And you can see there's just a sudden shift. And unfortunately for Harper, she doesn't hit selling the sterling, buying the dollars fast enough.
It'll come back.
Fucking punch it!
Fucking wait.
I'm not messing around.
All good?
Absolutely, of course.
Now, one thing that was interesting there, and I don't know actually if it was, but on the desks, there is something called a Squawk box mechanism. And what that is, that's a little speakerphone on your desk. So you don't actually call someone on the Squawk box. You literally type in their number and just start speaking, and it immediately comes up on the desk. And it kind of looked like the guy from middle office actually just did that. He just typed in the number of Harper's desk and just shouted at her, "Do it now," in earshot of everybody else. And that's probably why she'd executed the trade. I don't know to be for sure, but that's what it certainly sounded like to me.
Come collect your winnings. You won.
Won what?
Traders payroll sweepstake, 250 big ones.
Lucky bitch.
I entered your prediction for you.
So in this case, they've got a sweepstake on a particular number, and Harper's won, which is great. Obviously not one as much to cover her trading losses. Interestingly, we had a very similar thing on my trading program years ago at JP Morgan. We had to guess the rate of the yield on the 10-year government bond. And actually somebody gave me a little hint back from the line as on my training program. And they said, your prediction should always be the same as yesterday's closing price. And the reason for that is really just statistical, because the volatility isn't great. And as a consequence, if you start predicting high or lows, you'll generally overestimate the volatility. So by picking up yesterday's close, you generally will have less volatility in your prediction than you will do if you're just kind of guessing where it will be. And they were absolutely right. We won the game. So generally, if you're trying to predict financial numbers in a competitive situation, just pick yesterday's close for that particular number and you probably will win. Certainly if it follows a kind of normal distribution pattern.
We have a really competitive short dollar yen option. I've priced it especially for you. The rate is locked, but you'll need to execute pre-close.
I once had a Lehman saleswoman follow me into the toilet and try and flog me some MBS.
So there's just a few bits of terminology here that's worth explaining. In this case, Harper's pitching a short dollar yen position. So being short means you've sold a security that you don't actually own. So you kind of sell it, and before you actually have to settle and deliver the security to the other party, you've got to go out and buy the security. And what you hope by being short is that the price of the security will fall. So let's imagine that I agree to sell you 100 shares of JP Morgan, and the current price is around about $119. And I haven't actually got any JP Morgan shares at all. And I need to settle this trade, let's say in 3 days' time. This means what I hope is that by the time 3 days is up, the share price of JP Morgan has actually dropped to maybe, let's say, $115. And that means I only have to spend 100 times $115 to settle the trade, where I'm selling at 119, and that's my money. So in this case, what Harper's doing is pitching a short dollar yen trade. So this is one of the ways in which Harper is trying to get out of the trade, is this short position that she's pitching to the investor. Now the investor then comes back and says, well, actually, I've been pitched MBSs before. Now, MBSs stand for mortgage-backed securities. And this is a securitization structure. And what happens is a regular retail bank or commercial bank will write mortgages. And those mortgages will sit on their balance sheet. But what they can do is they can then sell those mortgages. And they can do that by setting up a trust vehicle or special purpose vehicle. And they will put the mortgages into that special purpose vehicle, and then they'll get the special purpose vehicle to sell new securities into the financial markets backed by that portfolio of mortgages. And the nice thing about that is that those securities won't be backed by a single mortgage, but a kind of portfolio of mortgages. They'll have the average risk of the mortgages. Now, the idea was that statistically you could model very accurately the risk of loss because you had so many mortgages within the pot. But of course, what tended to happen, people gamed the system. So if they had to have, for example, 600 credit points on average, the mortgages, and I think the top is about 1,000 credit points. So the very highest quality mortgages have 1,000 credit points. The lowest quality mortgages will have 0. But to get into the securitization vehicle, the overall portfolio would need about 600 credit score points on average. But of course, you can build an average of 600 points either by putting all the mortgages into the vehicle that have a 600 credit score, or what you can do is you can put some very high quality mortgages in at maybe 900 credit score, and then put some real junk in there at maybe 300 credit score, but you can still get an average of 600, which means you meet the criteria of the securitization vehicle. And that's the kind of things that were going on with the mortgage-backed securities. And what this meant is that there was ability for banks prior to the financial crisis to write mortgages to people who wanted to buy property at pretty weak credit standards. And they didn't really care because they could sell the mortgages into the special purpose vehicle. And once they've sold it into the special purpose vehicle, it's not their problem, it's the problem of the investors who have bought the mortgage-backed securities, in other words, the securities which the special purpose trust has sold backed by that portfolio of mortgages. And that's what she's talking about. And that was really the key thing that precipitated the financial crisis. And that's why she thinks they're so toxic and doesn't really want to know about them.
What was the final P&L?
200K.
No, it was a 140K loss.
Profit. 200K profit. I executed for you pre-close. Nicole at Malin Mercer.
So this is the end of the story so far in this episode, where Harper basically is saved by that asset manager, Nicole, who's basically picked up the trade and it made a profit of 200,000 rather than the loss of 140,000 or a loss of 50,000. Now, for starters, there's no way I think that this would actually happen. There's no way the boss would just let this go, because this is breaking all the compliance rules. And also Harper's no way can be able to trade at such a kind of early stage in her career. So I don't really think that this is realistic. And remember, the investment bank itself generally are not allowed to take positions and make money from the positions. They are in the business of market making a bid-ask spread and picking up that profit in there. That's why flow is so important to them. And even if you're in the asset management industry where you do take positions and that's how you make money, generally you don't want big swings. If you're making a lot of money from a single trade, people will generally think that you're taking tons of risk. And one of my friends in that industry says, basically, we want to make $50,000 a day continuously. We don't want to have massive swings because it just means that you're taking too much risk. And that is generally the principle of this. So it's actually a great episode and it's a great story. It's definitely great drama, but pretty unrealistic in terms of actually what would go on. So it'll be interesting to see what happens in episode 5.